Hello everybody, this is Toni Turner and welcome to the market now as of about 10:30 a.m. on Friday, June the 3rd. Hey, summer's here almost. U.S. stocks dropped today after much weaker than expected jobs data for May pointed to labor market weakness and raised doubts if the economy is healthy enough to absorb an interest rate hike from the Fed in coming months. The Labor Department this morning said non-farm payrolls increased by only 38,000 last month. That's the smallest gain since September 2010 and well below economists' forecasts of 164,000. The jobless rate itself, however, fell to 4.7%. That's the lowest since November of 2007, but the decrease was in part due to workers dropping out of the labor force. Traders are now pricing in only a 2% chance of the Federal Reserve increasing rates in mid-June, and that's sharply lower than the 20% probability traders established just before the payrolls data. So this unemployment report was quite a jolt to the stock market this morning. And on that cheerful note, let's look into three charts that could give us some insight into the week to come. First of all, we're going to look as we usually do. Last week we looked at a monthly chart. This week we're going to look at a daily chart again of the S&P 500 spider, symbol SPY. As you all know, this is the tracking stock or the ETF that closely follows our S&P 500 benchmark index. Now, when I captured this chart this morning, it was trading at, the SPY was trading at $209.23. Yesterday, it went back up and made a high, closed on the highs, at $210.93, back up to this 210 or 2100 level that we have seen so many times before. Actually, we can see right on this chart that we had an April high of $210.92. We can look back in November and see a high about there. We can look back in early November, see the same high about there. So the SPY likes to go up to 210, 211, which is 2100 about on the S&P 500. That is the all-time highs. And as you remember, the all-time high was in May of 2015 at $213.78. That's about 2137 on the S&P 500 itself. So this area has been a source of ceiling, limitation, aggravation, call it whatever you want, for the S&P 500 for the last couple of years, and it held again. And I think that a lot of people thought yesterday that we would break out here and move above that level, and that would have been oh so nice, but with this new report in suggesting that the U.S. economy is not as perhaps as robust as some people thought, the SPY is down a little lower today. So it is trading, however, bullishly. We can say above the 20-day moving average, the red line in this chart, above the 50-day moving average, the green line. Now, I've been putting a yellow mark here, excuse me, right about at the 204 level. This was an aborted head and shoulders pattern that did not play out, thank goodness, because head and shoulders patterns are top reversal patterns. Although this was a very shallow one, it did not play out. The neckline was not broken for any length of time. And price, S&P 500 being as resilient as it is, moved right back up, as we said, back up to this 210 and over that level again yesterday and actually for the past week. However, now we see a little weakness coming in again, as I said. The 50-day moving average here should act as support, or it could act as support. The green line is what I should say. That right now is at $206.94. So there's potential support there. Then, of course, we have potential support down at 204. Also down at about 202, where the 200-day moving average comes in. Something we might want to look at here, though, if we move on down to the 14-day RSI, we note that we have a bearish divergence on the 14-day RSI. And that means that while the SPY made a high, as I said, at $210.92 in April, made the same, virtually a high matching that or a little better yesterday. So those are pretty much equal highs. The 14-day RSI says I'm not impressed. To me, it made a lower high. That's what the calculation for the RSI is saying. To me, it's a lower high. It's not an equal high. When we see these kinds of formations on this momentum indicator, it sometimes can mean that there's more weakness in the asset we're looking at than meets the eye with the price pattern. So while it's not any reason to sell all your stocks and get under your desk, noting the negative divergence on the RSI is something we want to keep at our elbow in case we see any more weakness play into the SPY. The MACD, of course, is positive, still over the zero line. So let's keep an eye on the SPY in the coming week because, as you know, most stocks will follow the S&P 500 higher or lower. We'll watch it again come down to this 50-day moving average. If it does so, perhaps there's support there, and again down at 205. If it moves below the 200-day moving average at about $201, then I will be a little more worried. Okay, let's move on to the iShares Russell 2000 ETF. We've been using this ETF symbol IWM as something we've been watching because the Russell 2000 Small Cap Index can act as a leading indicator for the broader market. And recently it's been a very positive indicator for the broader market. The IWM broke out here over these prior highs in April yesterday at about $114 and change. Broke up over that this week. That's a real positive. However, this run up was broken today, at least in the short term. The IWM is now trading at $115.25. We have so far today a bearish engulfing candle, which is moving down, or at least a dark cloud cover so far today. At any rate, it is moving down to retrace yesterday's move up. The IWM is still above its 20, 50, and 200-day moving average. We've got to see, just like the SPY, can it maintain those highs? Can the IWM perhaps come down here, make a higher low, and then move higher? Is that something it can do? Or does it retrace all of its move, come back down to about 112 for the 50-day moving averages? Does it find support here or support at 111 where the 200-day moving averages are? Just say support all through here. If it can hold that, we may be good to go during the summer. If it cannot, if the IWM comes down and moves below 108 where there's definite price support, or should by any chance it move lower and move below 106, then we're going to have a little angst in the market, I'm pretty sure. Then we're going to want to look closely at our positions, and of course we'll be raising stops and even taking some profits. But hey, that may all not happen. It may find support here if it does have to move down for a few days and then move higher. We can also see in the RSI that the IWM is or was overbought, and it may need to take a breather here. So keep track of it. Remember, it can be a leading indicator for the broader market. Our final chart today is the VanEck Vectors Agribusiness ETF, symbol MOO, aptly named, I think, aptly symboled. The MOO has the top components in the Agribusiness ETF are Monsanto, Syngenta, Deere, ADM, excuse me, Archer Daniels, Midland, Tyson Foods. Now, this has stayed positive recently. And I think there's some good reasons to take a look at this, depending on, of course, what it does next week. The MOO is trading above its 20-day moving average, above its 50-day moving and average, and above its 200, but not so far above that I'm worried about it. What I would like to see here, it was trading today when I captured this chart at $49.32. I like this pattern. I like how it's had a steady move up since its January lows back here, made a higher low in February, has moved up and over its 50-day moving average, and pretty much stayed above its 20-day in a very mild uptrend since March, February, March, and indeed January. So if you'll notice down here, look at the volume coming into this since April. It doesn't have enough volume to day trade. However, this is something you might want to look at for the longer term, again, depending on what it does next week. If it can stay above, and I wouldn't mind if it pulled back here a little, in fact, I'd be happy. I want it to stay above 48, however, I want it to stay above the 50-day moving average. Should it fall below the 50-day moving average, I will no longer be interested. And of course, there's also price support down here just below the 50-day. So right in here is my line in the sand. If the MOO backs off or even breaks out here and moves up toward 50, I will be interested in it, again, as long as it stays above 48 in the 50-day moving average. I think these agribusiness stocks, some of them have sold off pretty dramatically, and I think there's a chance that they could make a run higher here. But it's just something to keep an eye on, again, with a very definitive stop in place. All right, let's go on to next week's economic reports. But first, please join us this coming Monday online from 4:30 to 6 p.m. Eastern for our next session of Toni's Market Club. We'll talk about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. This is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. And besides all that, at this time in the market, I believe it's very important for market participants to kind of know what's going on, know what approach to take next, and that's what we do in Toni's Market Club. So please join us. For those who cannot attend our live session, no problem. The recording of our session is available to all of our members just a few minutes after the session ends. And now for the coming week's economic reports, it's a very light week in the market for economic reports. On Wednesday, we have crude inventories. Thursday, we have jobless claims. And I'm putting in natural gas inventories. Natural gas is starting up here. It may be something you want to keep an eye on. Friday, we have the Michigan Sentiment Report. Again, join us for Toni's Market Club this coming Monday. Don't miss out on this fantastic opportunity to raise your trading knowledge and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.